Hey everyone, it's Tom Kratzer with another Rockstar Minute, and someone asked me a really smart question the other day. They said, what does it look like during a big real estate correction? So not like something that might be going on now where property prices in different segments of the market are different than they were a few years ago. I mean an across the board 30% correction. The kind we saw like in 1990 or that the US saw in 2007, 2008. And here's what we can share from those experiences. And I wrote down some notes. That's how important this stuff is. The first thing that you should know is access to credit is gone. The banks don't want to lend. It might be the reason for the correction in the first place, but access to credit is gone. That means new mortgages, credit lines are really hard to get. Any refinancing of properties you want to do, really hard to do. So that's the first thing. The second thing is any friends who told you they wanted to invest with you when the market bottoms out, because today isn't a good time to invest and they're looking for the bottom, they all disappear. So anyone who told you they want to buy when the real estate market tanks, they magically all disappear. So be prepared for that. I can't even speak. Number three is usually the people who bought 2 years before the crash. So for example, in 1990, if you bought in 1989 or 1988, you did go slightly negative during the crash. If you bought right at the peak, you went big time negative. But anyone who bought in 1987, their property prices during the crash didn't even go negative at all. And this has been the experience that we've seen multiple times when we look at most of the cities in the US data. It's only the people who bought the last 2 years before or during the big run up and before the crash that actually go negative. So that's just something to keep in mind. If you bought 5 or 10 years before, usually it doesn't even matter to you. And if you bought income properties, you're largely unaffected because most people during a crash talk about the price. But when you're buying income properties, you're not so focused on the price. You're usually looking at income and expenses. And if you bought a good property where the income is covering the expenses during a crash, you really are largely unaffected unless you were trying to refinance and access credit on that particular property. The next thing you should know is rents remain strong. So rents typically remain really strong during a correction. And the reason for that is there's no access to credit, but people still need a place to live. So even our friends in Ohio who had a massive real estate correction in 2007, 2008, they reported back to us that their rents remained strong. So if you look at the US averages, rents just plateaued out during that period and then continued to go up. So people still need a place to live, and it really drives the stability of rents. So rents don't collapse with real estate prices. And the last thing I wanted to share is that real estate activity picks up after usually about a year. So during a real estate correction or crash, the real estate transaction volume in the community will go way down. But after about a year, it picks right back up. And the reason for that is that some people think it's going to get worse, so they're selling. Other people are trying to take advantage of what they think an opportunity is. So if you're holding good pieces of real estate and you need to sell it, usually you have about a 1 year window where things are really tight. And after that, things loosen up again. Even if property prices continue to go down for like 2, 3, 4 years, the real estate activity picks right back up. So hopefully that gives you some things to think about. Until next time, your life, your terms.